April's CPI print landed at 3.8% year-over-year, the hottest reading since May 2023. And the surface explanation is simple enough. War in the Middle East pushed gasoline up 5.4% in a single month. But the number that matters most isn't the headline. It's that energy alone accounted for over 40% of April's entire CPI increase. That is not a broad-based price surge driven by demand. It is a single external shock compressing through the energy system into every downstream cost. The distinction matters because the Fed's toolkit was designed for the wrong kind of inflation. When the BLS reported that core PCE simultaneously hit its own 12-month high, the question traders were forced to ask wasn't whether inflation had returned, it was whether the Fed still had a path to cut rates before the war ends. The Fed enters this episode with the funds rate at 3.75%, already down 75 basis points from its September 2025 peak. That means the central bank is cutting into an inflation reacceleration, not holding steady. Edward Jones senior economist James McCann flagged the mechanism directly. With the Strait of Hormuz still effectively closed, the risk that April was not the peak of price pressures is rising. Oil recently hit $126 a barrel, up from roughly $100 just weeks ago. The 2021-2022 analog is instructive. In that cycle, the S&P 500 delivered a total return of negative 1.56% across nearly 2 years, as nominal earnings grew but inflation repriced risk premiums faster than companies could pass through costs. The setup today is structurally different. The Fed isn't starting from zero rates, but the underlying logic is the same. If energy stays elevated, every cut the market priced in this spring gets pushed out. What the inflation print left open was whether this is a shock that resolves when the war ends, or one that has already embedded itself into rent, food, and services, and that question pulls directly into the semiconductor sell-off.
The same inflation data that rattled rate expectations hit the chip complex from a second angle. Intel fell 10% in Tuesday trading, closing near $116 after touching $129 the day before. AMD dropped 5% alongside it. The immediate narrative was profit-taking after a parabolic run. Intel had gained 35% in a single week, AMD 34%. But the more precise read is that the valuation math stopped working the moment rate cut expectations shifted. Intel's forward price to earnings had stretched to 119 times on speculative catalysts, rumored Apple Foundry talks, a Bank of America price target raise to $96 that still carried an underperform rating. When the inflation print pushed rate cut timing out, the spread between a 119 times multiple and any reasonable discount rate became untenable. AMD was better anchored. Its rally rested on confirmed data center revenue of $5.78 billion, up 57% year-over-year, and a signed Meta partnership. But even valuations compress when the risk-free rate outlook shifts. The 2018 parallel runs through every trader chat right now, and the framing is technically accurate. In late 2018, SOXX fell 25% as the Fed tightened and trade war fears compounded inventory worries. But the countersignal from 2018 is the part the bulls are holding on to. Intel barely participated in that sell-off because its data center build-out was intact. Dispersion within the sector, not uniform damage. Today's data center demand story is intact. Nvidia just reported $68 billion in quarterly revenue, up 73%, and AMD's forward guide is near $11.2 billion for Q2. The Cerebras IPO, priced above range at $150 to $160 and 20 times oversubscribed, confirms that inference compute demand is not hypothetically strong. It is clearing capital at stretched prices right now. So Tuesday's sell-off does not signal a demand break. It signals that a 35% weekly gain had priced in a rate environment that April CPI just made less likely. The question that chip sell-off leaves open is whether the Beijing summit changes that rate calculus, because the single largest lever on inflation right now isn't the Fed, it's the Strait of Hormuz, and what happens to it depends entirely on whether Trump leaves China with anything useful.
Trump departed for Beijing on Tuesday, telling reporters that trade, not Iran, would dominate his agenda with Xi, but the two cannot be cleanly separated. Washington had just sanctioned 3 Chinese satellite firms for providing imagery that enabled Iranian strikes on U.S. forces. Beijing responded by deploying its blocking statute for the first time, ordering Chinese firms to ignore U.S. sanctions on Iranian crude buyers. The summit arrives with Iran already functioning as a secondary front in the U.S.-China rivalry, which means any trade deal Trump secures in Beijing carries an implicit condition: whether China continues to backstop Tehran's oil revenue while the Hormuz blockade inflates U.S. energy prices. The capital flow implications branch from that single condition. Boeing CEO Kelly Ortberg joined the delegation to Beijing with a 500-jet deal for the 737 MAX reportedly in discussion, a transaction that would directly address the trade deficit while providing China's airlines with planes they need. That deal is a legitimate positive for Boeing's order backlog and a real signal that the summit is oriented toward commercial outcomes. Apple's Tim Cook is also traveling, with foundry partnership talks forming part of the background. But the deeper lever for U.S. markets isn't the Boeing contract. It's whether Trump can extract any Chinese cooperation on the Strait of Hormuz negotiations, either by reducing Chinese satellite support for Iranian military operations or by facilitating the parallel diplomatic track through Pakistani mediators. If a framework deal with Iran is signed before Trump leaves Beijing next Friday, energy prices have a path lower, the rate cut timeline reopens, and Intel's 119x multiple becomes defensible against a different discount rate. If Trump departs Beijing without a diplomatic breakthrough on Iran, oil at 126 becomes the base case into summer, core PCE stays elevated, and the Fed is left with no clean exit. The verification benchmark is straightforward. Watch whether the Brent crude holds above $120 by Friday. A move below that level would signal that Beijing produced more than pageantry. A hold above it means the inflation shock that drove April CPI is not yet in retreat, and the chip complex's sell-off this week was a preview, not a floor. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.